Welcome to Talk Tickers, your insider pass to stripping away the corporate jargon from earnings calls and getting straight to the strategic gold. Today, we're pulling back the curtain on NAPCO Security Technologies, ticker NSSC. In a fiscal year where, many companies wrestled with macroeconomic crosscurrents, NAPCO presents a really compelling narrative. It's about strategic resilience, innovation, and a calculated shift towards recurring revenue that could reshape its future. Get ready to uncover how they navigated a pretty challenging environment while laying the groundwork for some significant long-term growth.
That's right. NAPCO operates in a truly critical sector, blending, the traditional world of security hardware with the rapidly expanding realm of high-margin recurring services. This latest earnings call offered a fascinating deep dive into how we're not just surviving, but actually thriving amidst external pressures like tariffs and inventory dynamics, all while doubling down on their most powerful long-term growth engines. You'll definitely want to hear about the strategic moves they're making, to capitalize on new opportunities.
Okay, let's cut straight to the numbers then. NPCO closed out fiscal 2025 with a stronger than expected fourth quarter. They reported GAAP EPS of $0.33, that's their earnings per share, calculated according to generally accepted accounting principles. It gives us that standardized apples-to-apples view of their profitability.
Right.
And this comfortably beat the consensus estimate of $0.27.
Yeah, a solid beat there.
Revenue also came in strong at $50.7 million, significantly surpassing the $44.4 million consensus. That represents a slight year-over-year increase, about 0.8%.
Mm-hmm. And what really stands out in these results is the continued and frankly accelerating growth in their recurring service revenue, or RSR. This stream increased a robust 10% year-over-year to $22.4 million in Q4. That's now representing about 44% of their total sales.
44%, wow.
And crucially, these services boast an impressive 91% gross margin. Yeah, 91%. To put that in perspective, many leading software as a service companies would be thrilled with, say, 75, 80% gross margins on their recurring revenue.
Yeah.
So NAPCO's efficiency here is truly exceptional. It really speaks volumes about the stickiness and value of their service.
That's a great point.
And while equipment revenue saw a 5% year-over-year dip for the full fiscal year, it rebounded significantly. It was up 27% sequentially from Q3.
Okay, so that suggests?
It suggests a meaningful easing of that much talked about distributor destocking,
Mm-hmm.
Overall, the market's initial reaction was positive, reflecting a kind of cautiously bullish sentiment despite some lingering challenges.
Right. Okay, now let's zero in on that RSR. You've emphasized its critical role in those, eye-popping margins. What specific aspects of its performance this quarter truly stood out, and what do those details tell us about NAPCO's long-term trajectory?
Well, what's fascinating here is that the RSR isn't just growing, it's genuinely reaccelerating. The run rate hit $94 million as of July. That was a remarkable $5 million sequential jump just from April.
$5 million in one quarter.
Exactly. Management highlighted this as the largest quarterly increase they've seen in 2 years. And that's not just a number. It's, I think, a critical inflection point. It suggests that previous investments in sticky platforms like their Starlink commercial fire radio, which they've really positioned as an industry standard, are now generating a compounding effect.
Ah, okay. The Starlink platform.
Yeah. This platform provides consistent mission-critical monitoring services. This high-margin revenue base isn't just profitable, it kind of insulates them from the inherent cyclicality of hardware sales. And it should be a key driver for a potential re-rating of the stock, shifting perception from a traditional manufacturer to a more resilient, almost software-like business model.
That makes sense. So while the recurring revenue stream is clearly firing on all cylinders, the equipment sales faced a more turbulent year. The term distributor destocking was mentioned as a significant headwind throughout the fiscal year. For our listeners, can you clarify what that phenomenon entails, and how did NAPCO manage to not just survive, but actually show signs of a rebound in Q4?
Sure. Distributor destocking basically refers to the process where their distribution partners, the middlemen, essentially reduce their inventory levels. This often happens in response to broader economic uncertainty, maybe anticipated slower demand, or simply optimizing their own supply chains.
Okay.
So it meant distributors were ordering less new equipment from NAPCO because they were busy working through what they already had on their shelves. This certainly impacted equipment sales throughout FY25, contributing to that annual decrease we saw.
Right, the 5% dip.
Exactly. However, that 27% sequential increase in Q4 equipment revenue, that's a powerful signal that this pressure is indeed easing. Kevin Bushell, NAPCO's president and COO, he commented that the tariff chaos has kind of cleared up and ordering activity has been robust.
That's encouraging.
Yeah, it suggests a return to more normalized purchasing patterns, which is a very positive sign for future hardware selling.
Okay. Now, tariffs were another recurring theme throughout the call, often blamed for impacting margins. How exactly is NAPCO managing those tariffs, and what's the expected impact moving forward into the new fiscal year, FY26?
Right. Tariffs certainly presented significant headwinds. They directly impacted the cost of goods and, consequently, equipment gross margins. So in response, NAPCO implemented two key pricing actions designed to offset these rising costs and, well, improve profitability. First, an 8.5% price increase was put into effect back in late April.
Okay.
Second, a standard 5% annual price increase followed in mid-July. Now, CFO Andrew Vano noted that Q4 saw the full impact of these increased costs, but only limited benefit from the price increases.
Why was that? Timing.
Exactly. Because many orders were placed before the new prices officially went into effect. However, management anticipates the full benefit of both these pricing actions to be reflected starting in fiscal Q1 2026. That should provide a notable lift to margins.
Got it. So Q1 should look better on that front.
That's the expectation. They also highlighted a strategic competitive advantage, their manufacturing operations in the Dominican Republic. They incur a 10% tariff there, which is actually lower than what many competitors manufacturing in Asia or Europe might face, often 15% or even higher.
So that localized manufacturing gives them a bit of a structural cost advantage.
Precisely.
Okay, beyond the numbers and cost management, what strategic initiatives are driving growth, particularly on the innovation front? This is often where companies truly differentiate themselves, right? And create future value.
Absolutely. And what's truly exciting here, and potentially a real game changer, is the major innovation they highlighted, the new cloud-based MVP Access platform. This isn't just another product. It's designed to extend their successful recurring revenue model into the massive and often complex world of access control and locking.
Access control. Okay, how does that work?
It operates on a by-door flat monthly model, which is a fundamental shift from traditional upfront hardware sales in this segment. CEO Dick Soloway referred to it as a game changer for a reason. It integrates innovative hardware with cloud services, offering a scalable solution for both large enterprise facilities and smaller businesses too.
Interesting.
For NAPCO and their dealers, it represents a brand new recurring revenue stream. It promises to increase customer lifetime value and significantly smooth business cyclicality by reducing reliance solely on hardware sales. Think of it. Instead of just selling a lock, they're selling security as a service for every single door.
Security as a service for doors. I like that.
Right. And they're aggressively investing in R&D to expand these recurring opportunities with new radio and locking products. Clearly aiming to replicate their Starlink success in other areas.
That by-door flat monthly model really does sound incredibly disruptive for the access control market. Can you elaborate maybe on how this is such a fundamental shift from traditional access control solutions and why it's a game changer for both NAPCO and its dealers? Like, what problem does it solve that existing solutions don't, especially for, say, enterprise and smaller facilities?
Yeah, that's a crucial question. Traditionally, access control has been very capital intensive upfront. Large hardware purchases, complex on-premise software installations, significant maintenance costs.
Right, big upfront investment.
Exactly. It often required specialized IT staff. The MVP Access platform changes this by moving it all to a cloud-native, subscription-based model. So for the end user, whether it's a small business or a large corporate campus, this means lower upfront costs, predictable monthly expenses, easier scalability, and remote management. Much simpler.
Okay, that sounds appealing. And for the dealers?
Well, for NAPCO's dealers, it's equally transformative. Instead of just a one-time sale, they now have a recurring revenue stream that builds predictable income month after month. It simplifies their installation and management process too, allowing them to serve more clients more efficiently. It basically solves the problem of cost-prohibitive, complex traditional systems, opening up market segments that maybe couldn't afford advanced access control before. It's about democratizing sophisticated security, really.
Democratizing security. That's a powerful concept. It certainly sounds like a strong balance sheet is underpinning these ambitious strategic moves and allowing them this kind of flexibility and investment power.
Indeed. NAPCO ended FY25 completely debt-free, which is a powerful position to be in, right? They had approximately $99.1 million in cash and cash equivalents on hand.
Wow, almost $100 million in cash, no debt.
Yeah. And they generated an impressive $53.5 million in cash from operations for the year. That's an 18% increase year over year. This financial discipline isn't just about liquidity, it empowers them to aggressively invest in R&D for these new recurring revenue platforms like MVP Access.
Makes sense.
And this robust cash generation also allowed them to return substantial value to shareholders. We're talking $13.6 million in dividends and $36.8 million in share repurchases. They bought back 1.2 million shares at an average price of around $30.40.
Okay, significant return to shareholders.
Definitely. And furthermore, they received a clean audit opinion on internal controls under Sarbanes-Oxley, which, for investors is a strong signal of robust financial governance and operational integrity. It really instills confidence in their reporting.
That's good to hear. So with all these strategic initiatives firing and a strong financial foundation, what does this all mean for the outlook for the next fiscal year, FY26? Were there any surprises or specific areas where management expects significant momentum?
Well, while no formal numerical guidance was provided for FY26, which, can sometimes be a point of contention for analysts, management expressed strong confidence in continued robust net income, adjusted EBITDA, and cash flow.
Okay, adjusted EBITDA. Remind our listeners quickly.
Sure. It's essentially earnings before interest, taxes, depreciation, and amortization.
Right.
Often viewed as a cleaner measure of operational cash flow before you factor in non-cash or financing impacts. They specifically expect equipment sales growth, with Kevin Buchel anticipating double-digit growth.
Double-digit growth on equipment after the tough year.
Yeah. This projection is largely due to easier year-over-year comparisons in the first 3 quarters. Remember that destocking effect. And also the full impact of those recent price increases now taking effect.
Right, the pricing power kicking in.
Exactly. They're also, as we discussed, aggressively investing in R&D to expand recurring revenue opportunities with new radio and locking products like MVP Access. Moreover, they have identified school security as an area of ongoing growth and, frankly, significant responsibility. Dick Soloway noted the frustration that, despite well-known incidents, some institutions, even well-known ones, still rely on outdated security responses.
Yeah, that's concerning.
It really highlights a massive, yet often under-addressed market potential for integrated solutions.
Dick Soloway's comments about outdated school security really hit home. It's almost unbelievable that despite, everything we hear about, many institutions are still behind the curve. Is this perceived inaction actually a massive greenfield opportunity for NAPCO? Or is it more of an uphill battle to educate the market and really push for adoption?
That's a good question. It's truly a bit of both, I think, but primarily a significant opportunity. The challenge is often bureaucratic inertia, maybe funding constraints, and sometimes just a lack of awareness about truly integrated modern solutions. However, the market need is undeniable and tragically constantly reinforced by events. And at PCO, with its comprehensive suite of security solutions, including access control, alarms, and now cloud-based offerings like MVP Access, is exceptionally well positioned to address this. The untapped potential, Soloway mentions, isn't just about selling new hardware. It's about shifting institutions towards ongoing proactive security management.
Which feeds right back into their recurring revenue model.
Exactly. It feeds directly into NAPCO's recurring revenue model. It's probably a long sales cycle, perhaps, but the total addressable market is immense, and the mission is undeniably critical.
Okay, so bringing it all together for our listeners, what does this all mean for investors? How should we interpret the overall sentiment from the call and the market's initial reaction, which, as you said, was positive but perhaps not explosive?
Yeah, the overall sentiment remains cautiously bullish, and for good reason. The strong beats on both GAAP EPS and revenue, combined with that robust RSR growth and healthy cash flow, those are clear positives. However, it's worth noting the market dynamics. The options market had actually implied a larger, maybe double-digit move in the stock price on the day of the call.
Oh, interesting.
Yeah, well, the actual reaction was a mid-single-digit increase, closing up just over 6%. This suggests that while the good news was largely anticipated by some, maybe the more sophisticated investors, others are looking for more definitive evidence of sustained hardware reacceleration and the full impact of those pricing actions in the coming quarters.
Okay, so waiting for more proof points.
Pretty much. And the lingering litigation overhang, which was mentioned as a driver of FY25 headwinds, also remains a factor impacting SG&A expenses, selling, general, and administrative costs. Some investors will definitely be watching that closely for resolution.
Right. So what then are the key things listeners should watch for as catalysts? Things that could truly move the needle for NAPCO in the near to medium term? Where should our focus be for validation of this positive outlook?
Okay, key things to watch. You'll definitely want to monitor the RSR run rate progression, ideally seeing it push towards or even above that $100 million mark. That would be a big psychological level.
The $100 million RSR run rate. Got it.
Yeah. A sustained recovery in hardware orders and a clear normalization of channel inventories will be crucial validation points for their equipment business recovery. Beyond that, look for early adoption metrics and tangible evidence of recurring revenue uplift from the new MVP Access platform. That will be significant proof for its game-changer potential.
We need to see that MVP Access translate into real customer uptake.
Exactly.
Yeah.
We need to see it translate into real numbers. And of course, any positive resolution or reduction in legal headline risk would clear an overhang and likely be welcomed by the market. The commentary from their fiscal Q1 2026 call, especially regarding hardware reacceleration and the full impact of pricing, will be a very, very important checkpoint for all these key trends.
Okay, Q1 call will be key. All right, it's time now for our This Is Not Financial Advice segment, where we pitch an outrageous but plausible trade idea, just like a hedge fund analyst, maybe after one too many coffees.
Okay. Well, given NAPCO's accelerating RSR momentum and the strategic launch of MVP Access, here's a thought for the truly forward-looking listener. Consider a long position on NSSC, but with a target price reflecting a significant re-rating of the company, as MVP Access drives recurring revenue faster and more broadly than maybe the market currently anticipates.
Okay, so betting on faster MVP adoption than expected.
Right. The core idea here is that MVP Access, with its innovative cloud-native buy-door monthly model, could dramatically accelerate RSR growth beyond the current 10% year-over-year rate we're seeing. If, and it's an if, NAPCO can onboard a substantial portion of its existing access control hardware customers to this new recurring platform, basically converting those one-time sales into sticky subscriptions, while simultaneously capturing significant new market share, particularly in that under-penetrated school security vertical we talked about, well, then we could realistically see the RSR run rate hitting maybe $110 million within the next 12-18 months.
$110 million RSR run rate in 12-18 months. That is ambitious.
It is. But this rapid acceleration, coupled with those impressive 91% gross margins on RSR and the company's enviable debt-free balance sheet, would justify a much higher multiple. It could shift its valuation closer to a pure-play SaaS security provider. Now, the outrageous part is betting on rapid cloud adoption in a sometimes slow-moving hardware-centric security industry. That's the risk.
Right, the industry can be slow to change.
But the plausible comes from NAPCO's proven track record with Starlink Fire radios, remember? And the clear, unmet market need for integrated, cloud-based access solutions that MVP Access aims to fill. It's really a bet on strategic execution and that market transition accelerating.
A bet on execution and market transition. Okay, that's a provocative one. And that wraps up our deep dive into NAPCO Security Technologies. It's clear that despite those macroeconomic headwinds and the challenges of distributor destocking, NAPCO really demonstrated remarkable resilience in FY25, particularly through its robust and continually growing recurring revenue model.
Yeah, there's strategic moves with aggressive pricing actions to offset tariffs, that powerful debt-free balance sheet enabling investment, and the truly innovative MVP Access platform. It all positions them for what management anticipates will be a strong FY26, especially with that expected rebound in equipment sales. They're not just playing defense, they're leveraging their core strengths to expand into new, high-margin, recurring revenue opportunities that could really redefine their business long-term.
Absolutely. And as always, remember that everything discussed here on Talk Tickers is for informational purposes only. It should definitely not be considered financial advice. We're here to help you get well-informed quickly and cut through the noise.
Right. We encourage you to dig into these insights further and consider the long-term implications of companies focusing on high-margin, sticky, recurring revenue, especially in our increasingly connected world. As security becomes more cloud-integrated and service-oriented, you have to ask what truly will be the next game changer in this space. What's going to reshape the industry landscape next?
A great question to ponder. Thanks for tuning in, everyone. We'll be back soon with another deep dive.